Good morning. It is Tuesday, March the 3rd. Here is what is on the agenda. Oil up again as stocks and bonds continue to sell off. Trump vows whatever it takes on Iran, and credit cracks at BlackStone.
Looking at markets then, Tom, US equity markets might have been pretty resilient yesterday, but US futures certainly point to some negativity once again in Tuesday's session. Tuesday looks negative for Europe as we continue to worry about growth and now increasingly inflation. Part of that inflation concern coming through in Brent prices up above $80 a barrel once again on the global benchmark for oil. Australia's two-year yield adding another dimension to that inflation conversation. It's rising up the agenda for global central bankers, it seems. The RBA saying that the March meeting for them is now live. The countdown to the opening trade starts right now.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
US Secretary of State, of course, Marco Rubio. And that is a reminder that almost 4 days into this conflict, Anna, we still do not know how this conflict ends up being resolved. But what we do know is there is a clearer focus now for the markets when it comes to the question of inflation. To your point, this is not just an energy shock, it's a supply chain shock as well. You take the two things together and the markets are starting to price in a more inflationary scenario. You have a major LNG facility in Qatar closed, the largest in Qatar. You have, of course, that refinery in Saudi Arabia, at least closed temporarily. The inflation question and the inflation shock is now being priced into these markets, and central bankers are starting to react.
Yeah, absolutely. Central bankers, as we said, the RBA paying attention. And we have another example of this morning. Gas prices just opening up 7 a.m. at UK time. And we have another jump higher in that gas price, up by 10% on the European benchmark. That takes us to 49 euros a megawatt hour. I felt slightly better about the inflation story reading Javier Blas's piece last night, where he reminded us that the price of that gas went to 345 euros, so not 49, back when Russia invaded Ukraine. So we're not in the same territory as that in terms of the inflation that will be unleashed by this. But certainly it is where the market is increasingly putting its attention. And not just because gas and oil prices are going higher, but because shipping rates are going higher. And that's for the tankers that carry the gas and carry the oil. But it's also going to be for cargo, one assumes, at some point. But if we look at the oil supertanker rates, they are now at a record. They've really spiked higher. This is we've got a chart that shows the cost of sending fuel from the Gulf to China. China pushing for the Straits of Hormuz to remain open for this reason.
Traders now pricing in terms of the Federal Reserve, not cutting not fully priced in until September. For the BOE, fewer than 2 cuts priced now for this year. Only a 40% chance of the BOE cutting when it comes to that decision in March. All of these factors seeming to play in to traders in terms of their pricing around central bank action. And to your point, this is a supply chain challenge, not just an energy challenge. Do we look to China when it comes to the Straits of Hormuz? Reports today that China is pressuring Iran to keep the Straits of Hormuz open. Of course, officially, the Straits of Hormuz are not closed. But in terms of effectively, that is the situation right now. But China may be starting to put the pressure on Iran to ensure they don't pull that lever.
And I know we're going to talk about insurance and the issues with getting insurance now, perhaps, to go through the Straits or anywhere near it. We're going to talk about that later in the programme. In terms of the oil price, we did see it jump up again. And part of that came as a result of the State Department putting out new advice to Americans in the region to get out of the Middle East. We will delve then further into what is happening in the Middle East right now. The US has sent conflicting messages about how long a war with Iran might last as the conflict reverberates across the region. Defense Secretary Pete Hegseth yesterday rejected the idea of an endless war with Iran, but President Donald Trump later insisted there was no fixed timeline. For more, let's get to Bloomberg Horizon's Middle East and Africa anchor, Jumana Basetchi, who is in Dubai for us. Jumana, we are thinking about the US strategic objectives, how long this lasts, and we're also just thinking about the day-to-day experience of those in the region. Bring us up to speed.
Thank you, Anna. Well, I think what's become apparent from this is there's no letting up in sight. It was pretty clear from what President Trump said yesterday. To borrow Mario Draghi's quote, they will do whatever it takes, he says, to complete their objectives. And he says, right from the beginning, we projected 4 to 5 weeks, but we have the capability to go far longer than that. So I think it's pretty evident from the language that has come through from the U.S. administration that they are not expecting for things to get wrapped up in the coming days, but rather coming weeks. That being said, later on, the defense secretary did say that this wasn't going to be another Iraq. It's not going to be an endless war. However, it is likely to be a protracted campaign so long as they are achieving their objectives. So that comes back to the original question, which is what exactly is the US's objective right now? Is it degrading Iran's offensive capabilities, in which case they will continue to conduct those strikes and attacks against key military infrastructure? Is it obliterating completely their ability to develop a nuclear weapon, which is, again, in reference to comments that Steve Witkoff made in an interview yesterday, suggesting that they were days away from getting to 90% enrichment, in which case they will continue targeting those facilities. And of course, they have also targeted key personnel amongst IRGC leadership and the Supreme Leader himself, which implies that they are, one of the objectives is ultimately leadership change and possibly even regime change as well, which has been put on the table. But at the same time, it is important to note that the U.S. are now beefing up their military presence in the region. They're sending more assets over here. They've also sent a warning urging U.S. citizens in the Middle East, and this is pretty much every single Middle Eastern country, to leave if they can. The problem, of course, is that there are almost no commercial flights available.
Jumana, thank you very much. Bloomberg's Jumana Basechi in Dubai with the latest from the region. And of course, for the markets, Tom, the question is very much around how long this lasts. And we look anywhere for clues to try and get some signal in the noise.
And our defence team have been looking at the ratio between interceptors, the missiles that take out the ballistic missiles, and drones that Iran is firing into the Middle East, across the Middle East region, of course, including the UAE, where Jumana, of course, is sitting in Dubai. And that ratio is based on cost, but also on supply as well. So the cost is about $20,000 in terms of what it costs, $20,000 to $30,000 for one of these Shahed drones, versus interceptors that can cost up to $4 million. But it's about the supply. And on some metrics, places like Doha in Qatar, of course, only have potentially 4 or 5 days left of supply. Why is that important? Because it could lead us to a view in terms of how we think about the reaction from these kingdoms and from these countries in terms of the pressure they may put on the Trump administration to try and scale back this military assault on Iran. So that is also something that the team have been looking at, is the defensive capabilities currently in place in the Middle East.
Yes, and I don't know what it tells us about the timing, but it does certainly focus our attention on that and on that defensive capability. There aren't many other stories that are cutting through, but highly read on the Bloomberg terminal is a story about private credit. And we were talking so much about private credit, we thought that perhaps that private credit conversation would extend into this week, and we have some news flow around BlackStone.
And maybe there is a thread, which is we're looking at high yields right now in terms of the sovereign bond space. High yields not helpful in a time and an environment where there is stress in the credit space. And we get a reminder, to your point, of that with BlackStone. Record redemptions from one of their flagship funds at BlackStone. They are allowing investors to redeem a record 7.9%. Typically, in a quarter, the limit is 5%. So this is a record redemption being allowed from one of BlackStone's flagship funds, 7.9%. And again, underscoring the concern amongst some investors about the health of private credit, and particularly the link between private credit and software companies, the exposure to software that could be disrupted by AI.
Yeah, absolutely. I mean, and if you're looking for the negatives, then you say, oh, this is more redemptions than expected, than usual. So this is investors wanting their money back. But if you're looking for the positives, this is not a fund that is shuttering. These redemption requests are not being denied. And BlackStone going out of its way to say that they are meeting 100% of these redemption requests. But after Blue Owl, this just got people a little bit nervous. And it is certainly a story that Bloomberg's audience is paying a lot of attention
to. They are,
to
your point, they are meeting those redemptions at BlackStone. UBS, though, put out that note, of course, that view. Private credit default rates could climb to 15%, if AI sparks aggressive disruption in the software space. Let's tell you what else we have coming up on the show today. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International, who's been thinking deeply about the different scenarios emanating from the conflict in the Middle East. We're also going to be speaking, as Anna was saying, about the insurance space and how that is tying in, particularly to shipping rates, with Marcus Baker, Marsh Global Head of Marine and Cargo, and Stephanie Niven, Portfolio Manager at 91, with a view on how to position amidst the geopolitical tensions. Tobias Elwood, former UK, Middle East and North Africa Minister, with a view on the UK's position in this conflict and how to think about how the Middle East and the situation, the war in and around Iran, continues to unfold, of course. So we'll get that analysis throughout the show.
Let's tell you what is coming up in your trading day ahead. We get Euro area CPI. Now, this is too backward-looking to reflect the expectations of inflation that might be higher, that might be shifting. 1.7% is the year-on-year number that we are expecting for the Eurozone. So that story perhaps a little too backward-looking to be relevant. But the UK Chancellor Rachel Reeves, she will be speaking. A spring statement will be delivered later on today, trying to make as few waves as possible, we understand. The German Chancellor Friedrich Merz is going to be meeting with President Trump. And interestingly, President Trump talking to a UK newspaper, talking favourably about Germany and about France in the most recent context. We get US primary elections in a few states, Texas, Arkansas and North Carolina. They'll be heading to the polls for those. And we do have some earnings from ASM International at 5 p.m. UK time, plus results out of the United States from Best Buy, Target and CrowdStrike.
OK, here's what else you need to know this morning. Then Bloomberg has learned that US officials are considering caps on the number of AI accelerators Nvidia can export to any Chinese company. The proposed cap would limit Chinese firms to buying 75,000 of Nvidia's H200 chips each, with shipments of some AMD chips also counting towards that cap. The limit is less than half of what firms, including Alibaba, privately told Nvidia they would like to purchase. Bloomberg has learned Elliott Investment Management and Macquarie Group are exposed to Market Financial Solutions, MFS, adding to the list of Wall Street firms caught up in the UK company's collapse. We're told Elliott holds about £200 million of mortgage-backed facilities tied to the failed lender. OpenAI chief executive Sam Altman says that the company's rush to forge a deal with the US Department of Defense looked, quote, opportunistic and sloppy. In a post on X, Altman said OpenAI was working with the department to make its principles clear, including ensuring that AI is not used for domestic surveillance of Americans.
Coming up in the programme, we will be speaking to the Spanish Foreign Minister, José Manuel Albares, as the world reacts to the US and Israeli strikes on Iran, his view on the European response. Plus, Jamie Dimon warning that there's more optimism in the market than there should be, given all of the risks. More from our interview with the JP Morgan CEO. Up next, inflation concerns are back, prompting traders to pare back bets on rate cuts from the Fed, also raising questions about where interest rates go in other geographies as well. We'll talk about the impact of that. ID plus BBTV Go is the function to use on the Bloomberg terminal if you want to get in touch with us. We really do like to hear from you. This is Bloomberg.
I'm not making a prediction about March, but it will be a live meeting. We have inflation at 3.8% headline and we have unemployment at 4.1, tight. The board will be actively looking at whether or not it needs to move more quickly. So I would discourage people from thinking that we necessarily only meet every quarter.
That was the RBA Governor Michelle Bullock warning inflation fears may result in an interest rate hike later this month. March is a live meeting. The comments come as traders from Sydney to Tokyo have offloaded government debt, pushing yields higher as they reassess the prospects for inflation. Joining us now, Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity. Salman, nice to see you with us. So we played that clip there from the RBA Governor. It's interesting in the Australian context, but also globally, because this is the first central bank governor, I think, that has spoken since the events of the weekend. And some of what she mentioned is domestic, but some of it seemed more international in nature. And I wonder how much more you're thinking about inflation as a result of the weekend.
Good morning. So I think I'm not surprised that central banks are starting to talk about it, and we'll expect more central banks to start opining on this because 22 is fresh in people's memories. The 22 shock was an energy shock, and it really built up that big inflation surprise, if you will, and we saw massive hiking. But it's early days still. For example, our assessment is that oil has to stay in $80-85 for at least 3 to 4 months for have meaningful inflation impact on the key consumers. And in the history is that Middle East has been episodic, so that conditioning is also currently in play, but it needs to last or oil prices have to go to $100, for example, to get that demand destruction. I think those are the two scenarios which are problematic here.
Yes, I mean, in terms of a number of voices saying, the US maybe is a little more protected from the inflation impact of this than Europe. Is Europe more protected than 2022 in terms of the inflation impulse that this might create, having diversified its sources of energy?
Actually, the problem is that once Europe went off Russian energy, it actually started taking a lot of LNG from Qatar. And that's where you have the choke point now. But obviously, US can be the swing producer here. But the question would be how Europe responds. Would they go back to Russia to fill that gap? Because no LNG is passing through the Strait right now. So this is a problematic area for Europe because their backup is now the one which is under pressure.
Just to be clear on that view, going back to the $80 a barrel, 3 to 4 months, that's when it becomes an inflation problem. Yeah. Are we underestimating the impact of the supply chain squeeze that's coming about as a result of what's happening in the Middle East as well, in terms of how you layer that on top of your inflation view?
So I think that is I would argue, like a second-order effect because the goods supply chain obviously can be re-geared. So we already seen some shipping companies using the Cape of Good Hope to reroute that. That's shipping delays. But the problem with oil and the geography of that region is that you have an east-west pipeline. Yeah. But that has a capacity of 4 million. But you have to offset 20 million. So 16 million gets stuck with nowhere to go. So I think it's at its core is going to be oil first and goods later.
But from what we're seeing, even from what we're seeing now, is there not an inflationary impulse?
I mean, this has to last. The 3-day disruption is not going to create a massive inflationary impulse. But if it continues to last and you have a situation where there's a stalemate, if you will, then we are in a potentially a problematic area when it comes to inflation.
Thinking about what this means for stocks then, Salman, I've seen lots of people trying to compare with other episodes of geopolitical tension and war in the Middle East specifically, mines going back many decades in some cases. But even in the 1970s, you find examples of where this was terrible for stocks and other examples of where stocks rebounded really quickly. Yeah. And it became a sort of sell the rumour by the fact event. Yeah. What are you thinking about stocks from here and their resilience or lack of it?
So I think actually what unnerves me is that we didn't get a spike because the historical pattern is you get a big spike and you fade it. And that has been I think the playbook for Middle East. This time around, there is no spike to fade.
When you say spike, you mean sell-off in stocks?
So in oil.
Right.
And then a big spike in oil, big pressure on stocks. But you didn't see much pressure on stocks. I mean, today there's some pressure starting to build in Asia. But if you look at the last 2 days, I mean, if I was thinking on Sunday, if somebody told me about this scenario, I would have expected more pressure on stocks. But then you fade it, if you will. So the question is that how complicated this situation is and the longevity and the duration. So I think it actually unnerves me that you haven't had a big sell-off. Because that means that we may see a build-up and convex moves after a certain point when inventories start to be run down. So we carried hedges into this event, but we also have a positive exposure to EM, which we are looking at very, very carefully.
Yeah, what does this mean for? I mean, they're just looking at the dollar move. Yeah. That typically isn't great for EM, but the dollar has been a lot weaker recently, so maybe there's space for this. Yeah. What does it mean for your emerging market assets?
So emerging Asia, there is a pecking order, and I think the market has started focusing on it. So you have Japan and Koreas of the world, which are very, very exposed. China actually is a relative immune because they have a lot of inventories, they can switch fuels, 71-day of inventory sitting. They have been doing strategic inventory building since Venezuela, if you look at the data. So we'll have to take some dispersed view. India is exposed because obviously it's a big oil importer, and then the dollar story. So we have to look at it from a more nuanced perspective. There will be some winners and relative losers out of that, but the longevity, again, the duration is the problem here.
It was interesting, we saw Mag 7 names, Nvidia, Microsoft, Palantir, not Mag 7, but tech names were playing a bit of a defensive hedge, at least were supportive of the US market yesterday. Does that dynamic continue, do you think?
So I think it's a question of, because they are not directly exposed to this nature of shock. But I would looking at 22 behavior. In 2022, when you had that commodity-led inflation shock, which topped up, there was other forces as well. Tech came under a lot of pressure because real rates started going up. So I think we have to be careful about that, what happens to real rate. And I think that's where the central bank shift will be far more important. So it can play the role of safe haven until central banks are not hawkish. The moment they start becoming hawkish and say, we have to do something about this inflation shock which is building up, then I think the 22-cent template becomes very, very viable, and tech did come under a lot of pressure in 22.
Okay, so that's tech in an environment of high yields and maybe more hawkish central banks. What about private credit? How concerned are you about private credit in a high yield, more hawkish environment, given the stresses that we're seeing there?
Yeah, so we have been looking at private credit for some time now. We don't think it's a systemic issue, but of course things are building up, concerns are building up. You have a liquidity concerns out there as well. We have been careful and flagging to our clients to be careful about private credit. In fact, in private asset space, we have been talking more about infrastructure and real estate in Europe, for example. But this is something we are watching carefully. I think one of the mitigators is that it is not a traded asset class. So you don't have mark-to-market VAR shocks, and it can play out over a longer period of time. So that helps the rest of the system. But within that private asset space, I think we have to be careful.
Let me ask you about China a little bit more, because we have a red headline, Salman, on the Bloomberg terminal. China calls on all sides to safeguard ships in the Strait of Hormuz. And this ties in with our reporting earlier that suggested that China was trying to urge Iran to keep the straits open. I mean, but they do seem to be pretty close in a lot of very real senses. But you were telling us about how China has been almost predicting this by stocking up. There's been a lot of inventory built in China ahead of this. So how cushioned is China?
I would argue they're quite cushioned if you look at the numbers. But at the same time, there were some reports that the only tankers which are passing through are Russian and Chinese tankers. So we have to think about the politics of this as well, geopolitics of it, because there's a wider geopolitical context here as well with the US-China rivalry, at the core of it. But our numbers suggest that they can easily traverse this for several weeks.
Yeah, we're seeing European government bonds are opening now, Salman, and we're seeing yields jump. And Tom and I were watching this yesterday. This time of day yesterday, it was quite quiet, wasn't it? And we were asking, which was going to dominate, the haven play or the inflation fears. Seems like we've got our answer.
It's more pronounced now, isn't it, to your point? So yields up 6 basis points on the 2-year over in Germany, up 4 basis points on the 10-year, and you're seeing similar dynamics over in Italy. BTP's selling off, OAT's over in France as well. 7% pop in yields on the French 5-year, a 5-6% move higher in yields on the French 10-year. So that selling pressure for sovereign Europe is there as we look at gas prices again increasing, up 16% in the session day, up 60% over 3 days.
Any role for European government bonds right now?
So we have been saying that for a while. This is not a world where bonds will be your stabilizers. The risk of recessions are lower because political economy in various developed countries means that there is a political appetite for not to have a recession. But that's not to say that supply shocks can't happen. And we are seeing series of supply shocks. This is not the only supply shock we have seen in the last few years. This is actually after like 6 or 7 big shocks we are seeing. So we have been continue to recommend that bonds are not your core diversifiers. It has to be gold. You have to do direct duration management or your equity exposure protection. Currencies have a role to play. And the reason why I think the European bonds have now woken up is because LNG went down yesterday. So the gas price link comes through. And as we were talking before, Europe has a decision to make. If the LNG doesn't come for the next few days, are they going to go back to Russia or not? I think that's a big decision.
Okay, well, that sounds like a far-off idea for Europe, but they are going to have to find energy and gas from somewhere. Maybe a bidding war between Asia and Europe over US gas as well. Something to think about. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity. Thank you. Coming up, as an increasing number of oil tankers gather in the Persian Gulf, Marcus Baker, Global Head of Marine and Cargo at Marsh, joins us to discuss the impact. Stay with us. This is Bloomberg.
Welcome back. 7:30 here in London, Tuesday the 3rd of March. Half an hour until the start of cash equities trading for this Tuesday morning. And the futures picture looks negative once again. So another day of concerns around the growth picture, around the inflation picture for European stocks. Yesterday we saw pain falling on the travel names, but also, even more than that, we saw autos down. We saw consumer products companies down. So, Tom, there seems to be a focus on what this does to the state of the European economy more broadly. So we're looking for another day of negativity.
And we have to think about how and what role higher yields play across the equity space as well, because The sovereign debt of Europe is not providing that hedge. There is the sell-off, and it continues, and it's more pronounced today, in fact. So yields are up across the board when it comes to the sovereign debt of the Eurozone. So selling off, yields higher as we look at gas prices up more than 20% in today's session. So building on the gains yesterday, you've seen prices up about 60% then over the last 2 days alone. You saw an almost 40% jump in European gas prices yesterday, and now, as you see, further gains in terms of gas prices up 22%. And there is a direct link between higher gas prices and what we're seeing in terms of the sell-off of sovereign debt in Europe as markets and investors start to adjust to what could be a higher inflationary environment as a result, of course, of the conflict in the Middle East. Now, millions of barrels of oil are sitting idly as oil tankers are hunkering down inside the Persian Gulf after attacks, of course, near the Strait of Hormuz, all but closed the waterway effectively, if not officially. The choke point has upended regional logistics, slowed exports and threatened near-term production. For more, let's bring in Marcus Baker, Global Head of Marine and Cargo for Marsh, with that focus, of course, on the insurance space and how insurers are adjusting to this. Marcus, what is your understanding right now of the disruption that we're seeing in and around the Persian Gulf?
So, I mean, I think the first thing I would say is that, the market itself is relatively calm. This is a process that we go through historically and have done so for many decades. I mean, back in the 90s with Desert Storm, there was obviously a process that the market went through in order to provide war risk insurance for vessels trading into that region. So I don't see at the moment a huge amount of real disruption. But what I would say is that if we had this conversation in 6 hours' time, I might be giving you a slightly different story, because I think it's very fluid, and I think we just have to keep on top of it and make sure that we're providing the right level of advice for the risk environment that's manifested itself.
That's interesting that you're not seeing marked disruption right now, but you give that caveat that things could change in the next few hours. So we monitor, of course, the developments in the region. But we have seen examples of insurers pulling their war risk insurance for some of these shipping companies. How extensive is that? Do you expect that to continue? Where are we in that journey? Because, of course, that is consequential in terms of allowing cargoes to move through this region.
Absolutely. And look, I mean, what I'm trying to say here is that there is a mechanism in place that allows insurers to reassess the risk. And that's exactly what they've done over the weekend and over the course of yesterday. And what we've seen, so to give you some examples, before the weekend, the rates for vessels trading into the Persian Gulf were around about 0.25 to 0.5%. And that's on the value of the ship for each transit that goes up into that region. What we saw yesterday was rates moving up to 1.25%. So that is a significant increase from where we were before the weekend's activities. And I suspect we may well see that go higher, especially after the overnight rhetoric from the Iranians around closing off the Straits of Hormuz.
Yeah, so good morning to you, Marcus. So are you saying then that the risk is insurable, it's just going to cost more?
I think there will be. Look, I mean, war is an extraordinary enabler for global trade. War insurance is. I mean, insurance is a global enabler for global trade, but war in particular, moments of extreme stress in the economy, in the environment, it's when the insurance market tends to step up and actually provides cover for these particular issues. And you can go way back into the 80s when things really started to get exciting in the Persian Gulf. It's probably the wrong phrase to use. But I do think, we've shown that we can operate as a marketplace. So I think that the danger we've got now is that some insurers, and obviously the environment is different, the munitions are different, the capability of hitting more tankers, more ships is different. So we have to be very cognizant of that as a marketplace. And I suspect more people will pull their horns in, and maybe we will find cover difficult for Straits of Hormuz.
In your experience, when operators of shipping are deciding whether to send their ships on a particular journey, how much of the decision is about insurance? You might be able to get the insurance, but, is that 80% of the decision, or is that just a small part of the decision as to whether you then decide to send your ships through?
If I was a ship owner, it would be a very small part of the decision. If you start to think about the dynamics of that with a $100 million 10-year-old VLCC, 1% is $1 million. Now, it sounds like an awful lot of money to those of us sitting around this table, but fundamentally, when we've talked about the price of oil going up by, up to $100 a barrel, then that's not that significant in terms of the overall cost. So I don't think it's cost. If it was me as a ship owner, and there's a lot more chat now, a lot more rhetoric around looking after crew. looking after crew, looking after the assets, those revenue-earning assets, which are critical to the future of those shipping companies. So I suspect it's more, it's a different level of exposure right now, and it's not about the insurance.
I just want to be clear on one point, because we have reporting that war risk insurance is being pulled by insurers for some of these cargoes through the Straits of Hormuz, but you're saying that in fact what's happening is that pricing is just going up in terms of the insurance costs.
So look, it's a marketplace. I mean, people are going to make their own decisions on whether they want to insure vessels going in through that region or not insure.
So it's a mix of both. I mean, we're kind of 50-50. What is the mix right now in terms of insurers that are pulling versus just increasing rates?
So just to explain that. So every single insurer, as far as I know, has issued a notice of cancellation to say, because they have that opportunity to do that within the policy terms and conditions, and they basically said, we would like to reassess the risk.
Okay.
So their option now is, do we continue to provide cover? And if we do so, what's the rate that we want to charge? Or do we actually say, I'm really sorry, that's not a position that we want to go down? Now, from our perspective as brokers, so our clients are the ones trading up into that region. We want to make sure that we are continuing to provide an avenue for them to do that, if that is what they want to do.
In sticking with the region, but a different area, and this won't be relevant to the cargoes that are trying to get out through the Straits of Hormuz, but is relevant to the wider conversation. What about the Red Sea and Suez and impacts there, you know, the Houthis and the risk attached to attacks in that area? What are we seeing? What's the latest thinking from the shipping industry about the risks there?
Incredibly fragile ceasefire, obviously, over the course of the last month or so. What we saw probably 2 weeks ago was some of the major container carriers announcing that they were going to start to trade back again through the Red Sea. And I think that gave a lot of us a great deal of comfort that that was going to start to take place. However, as of this morning, I've seen that CMA CGM, Maersk, MSC, the major container carriers have basically said it's just not worth the risk. So they will continue to carry on around the Cape.
The long route,
Before we let you go, Marcus, does this all mean higher costs for consumers, ultimately?
Well, as I said, I mean, if it's a 1% or 2% rate on the insurance, that's probably only half a cent, maybe less than
minimal at this point.
On a barrel of oil. So relatively speaking, yes, it is an increase, but I don't think it's going to be significant.
Marcus, thank you very much. Thank you for joining us. Marcus Baker, Global Head of Marine and Cargo for Marsh. Geopolitics dominates the market narrative.
Geopolitics is a major issue. It's much more complex today than it has been since World War II. I'm talking about Ukraine, Russia, Iran, North Korea, all related with China. And that could have an effect, but it may not. So these things may diminish over time.
JP Morgan CEO Jamie Dimon, of course, speaking to Bloomberg. Up next, we'll take a look at energy markets as the conflict in the Middle East continues. This is Bloomberg.
Welcome back. We're about 18 minutes from the opening trade. European futures pointing lower again, down 1.6% after losses of a similar amount yesterday. US futures also in negative territory after holding the line yesterday. US futures, S&P E-minis pointing lower by 1%, Nasdaq 100 futures pointing by 1.3%. But again, on high gas prices, European equities under pressure again. We've been hearing from JP Morgan CEOs, Jamie Dimon, of course, warning that markets are showing more optimism than they should, given the risks, including the conflict in the Middle East. Speaking with Bloomberg in Miami, Dimon said inflation could run hotter than expected, especially if the US and Israeli strikes on Iran keep oil prices elevated.
One of our brilliant folks wrote a report years ago, Mike Semlis, that if you look at all these wars around the world since World War II, the market reacts, but it never had a real long-term effect other than the Israeli conflict when oil prices tripled and went on for an extended period of time in 1973. So the world kind of takes this in stride, but geopolitics is a major issue. It's much more complex today than it has been since World War II. I'm talking about Ukraine, Russia, Iran, North Korea, all related with China. And that could have an effect, but it may not. So these things may diminish over time. You know, this war with Iran, you know, if it is short and oil goes to 80 or 90 or 100, but it's a short time, it's not prolonged, it probably won't have a major effect. If it becomes prolonged, then all bets are off the table.
Well, how offsides would this market be if there were truly a stagflationary shock, given the fact that there seems to be comfort with the idea of disinflation right now?
Well, I think that's true, but I think that was true before this war. So if you look at, my view is the prices, asset prices are kind of high, credit spreads are kind of low. There's kind of a lot of complacency in the market. I'm not sure, we look at risk, we look at the broad range of outcomes, and there are negative outcomes, but one of them would be, inflation. I call that's the skunk at the party. So it's been coming down, but it seems to maybe have leveled off around 3%. If things make it go up, and this is only one thing, you can look at medical prices, construction prices, insurance prices, wages for certain things, other things, inflation is a big thing, it's not just oil. So we'll see. Right now, this will add a little bit, literally a teeny bit to inflation, not a lot.
I was surprised because things were kind of gloomy coming into today, and the mood here is not that. Actually, there's a lot of optimism. There are a lot of different companies that are building things and investing things. I mean, how vulnerable really is the U.S. economy right now to some sort of geopolitical shock?
Well, it may not be geopolitical. It may be the companies who start to lay people off. And so I look, the most important thing in the world today is geopolitical. What happens to the free Western democratic world, which has kind of been under attack by Russia and Ukraine, by Iran in the Middle East, a little bit by China, who wants to, divide and conquer the Western world, and, both militarily and economically. You have all their neighbors are rearming because of their actions, not because of anyone else. So those are the most important things. I'd add global deficits are so large, but those are like, I call them like large moving tectonic plates that may or may not affect the economy in the short run. They may be determinative in the longer run. And some of these things, when you talk about war, Vietnam, did it affect the economy in the very short run? No. It had a 20-year effect after that. So you got to look at these things as they're moving plates that can take 5 years to have an effect, but effectively real. Right now, the economy is doing fine. Asset prices are high. People are assuming things go on. I mean, no one you talk to has any idea the credit spreads can gap out a lot. And they could, just because of sentiment. And so yeah, I think there's a little bit of a little more exuberance than I think there should be. But we've had years of it. And the one big beautiful bill adds to growth this year. Bank deregulation, other deregulation adds to growth, and animal spirits. So we'll see. But you pointed out, I think the skunk would be inflation. So we got to keep our eye on that one closely.
The JP Morgan CEO Jamie Dimon speaking with Bloomberg's Lisa Abramowitz in Miami, talking there about big tectonic plates shifting in the global economy and about inflation risk. And that takes us on to our next story. The global energy markets continue, of course, to be upended by war in the Middle East as it escalates, with Tehran threatening a full closure of the Straits of Hormuz. For more, we're joined by Bloomberg EMEA News Director Will Kennedy on set with us this morning. Will, let's start with the gas prices, because this actually was triggered by the shutdown of Qatar's massive gas facility. So we saw a big surge at the open yesterday. Then we saw another surge when we got this news from Qatar yesterday. And now we have another jump 25% higher on TTF this morning. What's the context around this gas story that we in Europe need to be aware of?
So Qatar, this plant produces 20% of the world's LNG. So a prolonged disruption there can really have a knock-on effect through global gas markets. It's a particular problem with Europe, where you're seeing these massive gas price jumps because it has become very dependent on LNG from the Middle East and from the US after it stopped buying pipeline gas from Russia after the Ukraine war. So if this were to continue for a while, if these gas prices were able to stay at this level for some time, it clearly would put upward pressure on European energy prices.
Well, where could Europe turn for additional supply of LNG?
That's quite difficult at the moment because the US has become another key supplier, but it is pretty maxed out, its plants, and it is building more plants, but that takes time. The plants that it has is supplying at probably as quick as it can. So there aren't that many places that it can turn. There will be more supply coming on globally over the next few years, but right now, and inventories at the end of this winter are relatively low in Europe, right now it would be a bit of an issue if it had to replace that gas for a long period of time.
I was looking at charts of implied volatility for oil markets, Will, and it seemed as if, of course, the 1 month horizon was reacting, but also the 3 months. And people asking, is this going to be different to a year ago? Is it going to spike up and come back down again like it did a year ago? Or is this going to be prolonged? What's your sense?
It will all depend on how long Well, in the short term, it will depend on how long this de facto closure of the Strait of Hormuz carries on. It's closed essentially because tankers, big tankers, the VLCCs, and that carry most of the oil out of the Gulf aren't transiting that strait. Traders will be very keen to see if that changes in the coming days, whether perhaps the US Navy signals that it's okay to start transiting that strait again. If that happens, oil traders will draw a big amount of relief. But what is really worrying oil traders at the moment are these drone attacks from Iran against energy infrastructure, as well as Qatar. We saw a big refinery in Saudi Arabia hit yesterday. And as long as that threat remains, traders are going to be very nervous about the prospects for disruption from the world's most important energy-producing region.
And well, we've been talking about the fact this isn't just an energy shock, at least in the short term, but it's also a supply chain shock as well. Where is that showing up in the Middle East?
Yes, I mean, there's not just obviously tanker shipping, there's container shipping. The Jebel Ali port, which is a really important hub in the UAE, closed for a short while. There aren't that many ships going in and out. There aren't container ships transiting Hormuz, and that will slowly have a knock-on effect through global supply chains. And of course, there's the air angle as well. These airports, which have been closed for the last few days, Abu Dhabi, Dubai, Qatar, as well as being some of the world's biggest passenger hubs, are some of the world's biggest cargo hubs, and it will be throwing all these very sophisticated supply chains into disarray the longer that these disruptions go on.
Okay, well, thank you very much. Will Kennedy, Bloomberg EMEA News Director, many years following specifically the oil beat as well. So thank you very much, Will, for joining us this morning. Let's broaden our conversation and speak with our Markets Live Executive Editor, Mark Cudmore, who is with us. Mark, good morning. Looking at what you've been writing over the last couple of days, it seems as if you maybe think that markets aren't reacting quickly enough to the developments in the Middle East. In which assets do you see that most notably, Mark? Is that a stock story? Is it oil?
It's not so much the speed of reaction, it's kind of the delayed attitude is very complacent. I think that over the weekend, what we saw was a game-changing event. I'm always in favour of not being too knee-jerk. Monday's price action didn't surprise me too much, but as we've had time to process it, it is fair to acknowledge that almost nobody I spoke to expected the Iran situation to be like this week. They did not expect the scale of attacks. They did not expect the scale of retaliation from Iran on all its neighbourhood. They did not expect the disruption we've seen to the Strait of Hormuz. So everything we've seen is game-changing. Now, some people may dismiss it as it's only temporary, but people aren't yet acknowledging that, we've had a major event happening, and we are seeing an energy price shock. Some people, I'm glad to see, Will is very much my camp there, talking about the energy price shock, talking about the supply chain shock. But many people yesterday were dismissing about, the one-day move is irrelevant, it's only 8%, that's not a big factor. That ignores the fact that Friday close was the highest close since July last year. We are already trading, before the weekend, 10% above the average of the last year, almost 10% above the average last year in Brent crude. We're now 20% above the average of the last year. Gas prices are more than 50%. UK gas prices are something like 70% above the average of last year. We're having an energy shock. Yes, we can debate about what extent, how long it extends, but we've got an energy price shock. We've got a supply chain shock. We're therefore going to get higher yields because we've got an inflation impulse coming through, and that's not good for what we're happening in the credit sector. So consumer sentiment is going to get hurt by wealth effect, by higher prices, by higher yields, and just generally they're seeing images of war on their front page around the world. So I think equities will reprice significantly lower over the coming weeks.
Yeah, well, we're certainly starting to see that in the Asian session today, aren't we, with some really heavy selling across the benchmark, but also in places like Korea. Mark, do you think we rewrite the playbook then for central banks as well this year on the back of what we're seeing in the Middle East?
Look, I mean, the Fed was the main one in trying to push through easing, and many people in the market were already cynical about that. I do think it's going to make it more complicated for central banks. I think the Fed is still going to be under pressure to cut given half a chance, which, is going to be complicated. But yes, I mean, look, I think we're getting some sort of inflationary impulse here. In a world where yields had dropped a long way, and that's, I think, part of the problem here, is the positioning was not ready for this. We had seen dollar softer, and the dollar is the ultimate haven from this asset. We'd seen yields much lower, and we'd seen the main stock markets gain be those Asian equity markets that are of major energy importers, things like Korea, Japan, China. So I really think the market is not positioning this for all. Now, I'm not expecting a shock move, but I just think that the risk aversion is going to gradually deepen over the next coming weeks. And I think we're going to see a much larger sell-off. And yes, that will mean yields higher as well, but a bit more mixed.
Yeah, and certainly the sell-off in bonds is extending in the session today as we look at European sovereign debt. Yields up now 6 basis points on the 2-year over in Germany. Bloomberg Markets Live Executive Editor Mark Cudmore, thank you, of course. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. This is the moment, if it hadn't been before, to really follow that analysis, of course, on the terminal, given the events in the Middle East.
Yeah, absolutely. I mean, futures here in Europe then, looking negative, Tom. Once again, it looks as if the German market could be the epicenter of it for us. So the Xetra DAX futures there down by 1.7%. FTSE futures maybe suggesting a bit more resilience in London. That is what we saw yesterday to some degree, because energy names listed in London as well as elsewhere, but that helps London. So yesterday we saw energy the only sector in positive territory, and it was all reflections of a weaker European economy that were down. It wasn't just travel stocks, it was consumer products, it was also autos as well.
And potentially a less supportive backdrop from the central banks. And now, just to reiterate, for the March decision for the Bank of England, markets and traders pricing in far less than 40% chance, between 32% chance now. That is a significant adjustment in terms of the views in March for the BOE. In the ECB, traders now see a 25% chance of a rate hike from the ECB this year.
Yeah, so the central bank governor in France trying to play down French exposure, saying exposure to Middle East tensions in France is limited. That just coming out on the Bloomberg terminal right now. But broadly, we watch the repricing of rates across Europe. And we wait for the European market open for cash equities. That's coming up next. This is Bloomberg. Welcome back to the opening trade. Just a couple of minutes until we get the opening trade for cash equities for Tuesday here in Europe. And what are the useful inputs into the European session? And we ask this because usually we are very focused on what's been happening in the US session the night before. Does that give us any clues about where Europe goes? But Europe and the US seem to trade very differently yesterday. Europe saw some substantial losses, some real fears around inflation, but also growth. There was a bit of that at the start of the US trading day, but then US stocks really started to recover. Will that assessment of US resilience, economic resilience to what's happening in the Middle East, will that endure, or will there be a different assessment around what happens to the US? US futures also a little bit lower, and European futures are then lower. We are expecting to go lower at the start of trade, down another 1.7% on Euro Stoxx 50 futures. And Tom, that really begs the question, will it be the same sectors as yesterday, those exposed to the European economy, that go weaker?
The lens is very much on the energy space, and that ties into the European picture, of course, with gas prices up now about 80%, Anna, in the last 2 days, spiking again in the session today. We're watching energy then as a sector, with the oil prices also higher on Brent by about 3%, back above $80 a barrel. The defence sector, of course, you saw that gain, particularly in the defence names of Europe and the US yesterday. That was supportive for the broader indexes stateside, along with Mag 7. But of course, we're also watching shipping, with rates there continue to grind higher. China coming out and pushing around their concern that the Strait of Hormuz remains open. So the shipping constraints on what is effectively now a closed Strait of Hormuz, if not officially. So those are the main sectors we continue to focus in on today, Anna.
Yes, and we were having a conversation about insurance in the marine space, and we were hearing that in a slightly different part of the Middle East, that the whole Red Sea conversation, that's going to be pushed to one side again, and ships are going to continue to go around the south of Africa, which again plays to higher shipping rates and maybe is a positive for some of those shipping companies. That's what we saw a little bit of in the session yesterday, and maybe we get some more of that today. So the start of the European equity trading session, I'm talking about shipping as we're waiting for these broader European equity markets to open up. So the FTSE 100 down by 0.6% at the start of trade. Yesterday, as we said many times, we have seen a bit more resilience coming through in London, and part of that is delivered by the exposure to energy names, the likes of BP and Shell, still heavily weighted in London, and as a result, there's a little bit more resilience. The CAC 40, of course, has Total Energies. That is down by 1.3%. A lot of focus yesterday in the French market on the consumer exposed side of things, the autos, the consumer products, the luxury goods. The IBEX down by 1.4%. So once again, we're seeing negativity, Tom, across these European equity markets. The Asia session was pretty negative. We should say that Korea was back from a holiday on Monday. So maybe the Asia session looks even more negative than it might have been expected to do on the Tuesday of the weekend story. But certainly we're continuing to look for signals in what is an incredibly complicated picture in the Middle East.
energy is the only sector that is in positive territory so far. So on a sector-by-sector basis, energy up 0.3%. On the downside, the biggest losses coming through for basic resources, currently down 2%. You do have slightly weaker, you have weaker silver prices and weaker copper prices as well. That seems to be weighing on basic resources. We'll see how that adjusts, though. Utilities also lower by more than 2%. Travel and leisure, and you saw the significant impact yesterday, particularly around hotels and airlines and the constraints there in the Middle East. That sector is down almost 2%. Banks were under pressure yesterday. That narrative continues today as well, currently down close to 2% as a sector for banks. And again, it is energy that is the only sector in positive territory right now, up 0.3%. European natural gas prices spiking again this session. Brent above $80 a barrel.
Yeah, really interesting that we're seeing basic resources at the bottom of the basket, and the worst performing stock in there seems to be Fresnillo, which of course is a precious metals miner. We've seen the numbers hitting the tape, but we've also seen, of course, some movement in silver prices. And sometimes in times of stress, you sell what you can and not what you want to. And so silver prices have been weaker and are down another 2% today. That's not the case for oil prices. They are up. And so to your point about energy being the only sector that's positive, energy stocks go higher, basic resources go lower, and we have that sort of divide across the European equity space this morning. Let's try and make sense of what we are seeing across markets. Stephanie Niven joins us, portfolio manager at 91. And Stephanie, nice to see you this morning. Thank you for joining us. We do seem to see a different story being told in different geographies about, well, let's start with stocks, about where stocks can go here. The story out the US seemed to be one that was emphasising the resilience of the US economy and maybe trying to draw a line between in the sand there. But then you look back at US history, and stocks sometimes in geopolitical tense periods go higher and are resilient, and other times they drop. I mean, what are you thinking about the stocks environment from here?
Sure. So what a week to be talking about the markets. And I think the three things we're really thinking about here at 91 are the impact on oil and the transmission through inflation and what it does to the anticipated Fed path downwards. We're thinking about broader asset classes, so the transition into emerging market debt. But you're exactly right that the impact on global stocks, the global equities, emerging market kind of businesses is something that we're really going to have to watch from here. And this kind of war hits at a very interesting time for the market. You know, headline numbers look like we've had a relatively calm year, and that really hasn't been the case. You know, we've seen really significant moves within software, and we've also seen that beginning of cracks within the private market space as well. So kind of seeing how those ramifications come into the market today, I think perhaps the US won't be the same today. And you're exactly right to call out some of the impacts within Asia, and we're seeing that transition mechanism of oil prices begin to feed through.
Where are you focused then in terms of the European downside, where and maybe even resilience? Where do we look then, Stephanie? Because, I mean, energy is the obvious area of resilience. We see that for a second day here. On the downside, though, yesterday the focus was on consumer goods and anything that could be hit by a slowdown in the European economy. Today's a bit more complicated. We've got insurance and utilities weaker. I note the higher yield story in Europe as well. I mean, what do you think about the sector rotation that this could prompt within Europe?
I think we could continue to see a lot of the heightened sector kind of rotation activity that we've seen year to date. So kind of dealing with that idea of higher inflation, but also lower growth, and how we think that feeds through to asset pricing. We've looked at some of the oil price kind of sensitivities across the economy. So a kind of 30% rise in oil price could lead to a 1% shock in inflation, which leads to a 0.13% decline in realised growth. And, those feed through in many different channels. I think for us, we continue to look for the resiliency of business model. We've heard a lot, particularly last week, about AI and how we're beginning to transition through from that hyperscaler kind of capex headline focus into actually what does this mean for the real economy? How will we start to see productivity feed through in ways that rewire a lot of economic value creation?
What parts of the European equity space are most vulnerable to this energy shock that we're now seeing emanating out of the Middle East? Or is there that corporate resilience built up over COVID and supply chain hits as a result of tariffs?
Sure. I think there's a degree of corporate resilience. We always stay in those names where we think that there is that ability to generate free cash flow, where a lot of the business fortunes effectively remain within management hands. I think it will be interesting to see really some of the responses. So, what companies are out there talking about the impact on their business models going forward and how they ultimately think about deploying strategy, deploying capital allocation, and perhaps accelerating some of the changes that AI will bring into, our global economy.
But on a sector-by-sector basis then, that area where management has more control, where does that take you? I mean, a lot of guests we've had coming onto the show have talked about the banking space, for example, and European banks continue to outperform. They've been pretty badly hit in the last couple of days, maybe on expectations the economy doesn't perform as well in a higher rate environment. Where are you seeing, where do you want to be leaning into on a sector-by-sector basis where you're finding some kind of hedge or some kind of resilience in this environment?
I think we're really interested in names like Schneider Electric, where they continue to feed that build-out of the AI ecosystem, where they continue to kind of think about how customers are going to respond and rewire their own business models. We'll look at things like healthcare as well, where the underlying sustainable kind of structural growth dynamic stays in place. We tend to stay away from some of those more precarious, more economically and commodity-sensitive names.
Let me ask you about emerging markets, Stephanie, because you referenced this earlier. We talked to a guest in the last hour about this as well. I mean, I go to the dollar and look at the strength that we're seeing in the dollar since the weekend. What is that going to do to derail interest in emerging market assets, which have been really popular with the weakness of the dollar?
Sure. I mean, you can't broad brush emerging markets entirely. There's a difference between Asia, there's a difference between Latin America, South America, and thinking about the different kind of exposures there. And obviously, Asia is a net importer of energy. I think it comes down to the business models. It comes down to that kind of degree of resilience. One thing we're looking at is how moving beyond some of these kind of hyperscaler capex plays into kind of that productivity, into the factories, into thinking about how things automate and transition in an AI future.
Okay, so it sounds as if you still think that these AI themes, that the rotation that we were talking about over recent weeks, away from hyperscalers into other parts of the AI beneficiaries, you still think that is a trade that can cut through in this environment?
At the moment, we do. Obviously, the intensity of what's happened in the Middle East so far has been surprising. However, we think that, markets are resilient more broadly. It will be active investors will have to think more deeply. They can't just remain on the kind of headlines of things. They need to think beyond, the management rhetoric and move into the exact underlying exposures. But we are pretty optimistic that this is not a catastrophe for economic markets.
What would you get? What is the kind of metrics you're looking at, the gauge that you're looking at that would change that constructive view on equities? Is it oil above $100? Is it oil above 120? Is it a conflict that continues for 3, 4, 5 weeks and spreads in the region? What are you looking at? What would change that relatively constructive view on equities in terms of the geopolitics we're seeing?
Sure. I mean, oil price is obviously the key transmission into the real economy, but we're also thinking about inflation. So when we begin to see inflation kind of move, what that might do to the labour pool, what that might do to accelerated job losses, perhaps in this world of AI. OK, and inflation is a metric that is obviously supported by what's happening. The oil price is there a level? Is it going to $100? And this becomes a problem. I mean, we're talking about, again, we've been hitting the fact through this show that this isn't just an energy shock; it's a supply chain shock as well. Exactly.
So, how clear are you in terms of when and if inflation comes through in a significant way, and when to change that kind of asset allocation?
So the sensitivity that we've been running through our investment institute is thinking about a 30% real rise in oil prices and what that will do. And that's the point at which you get that 1% shock on headline inflation, and that's the point at which actually real growth begins to deteriorate. So that's the kind of region in which we're focusing our efforts. And obviously we're around 73 for WTI and 80 for Brent. So kind of looking at where we go from here, and I guess we are pushing into that kind of $100 realm.
Stephanie, we have been talking a lot about private credit in recent weeks. We've been talking this week all about the devastating events in the Middle East. What are we not talking about that should be on investors' radars when they try to keep calm in the face of so much news flow? What is getting lost?
So I guess it's that underlying kind of dynamic of competitive advantages. What is happening to competitive advantages as we begin to see the economy rewire through a age of AI? A couple of weeks ago, we were all extremely focused on software, whether there was any terminal value within software, and trying to understand, the sector as a whole might be disrupted, but actually there are pockets where we are embedded, where those businesses will see resilience. That's the area to focus on as an active investor.
OK, Stephanie, thank you. Thank you very much indeed. Stephanie Niven, Portfolio Manager at 91. Let's have a look in on the Core 6 on another day, of course, of challenged equity trades and pressure broadly across your sectors. You are seeing Novo Nordisk within the healthcare space, something Stephanie mentioned there in that conversation in terms of healthcare. So Novo actually showing a little bit of resilience in this environment, up 0.6%. Everything else, though, in negative territory. Nestle, though, in the consumer staples, showing a little bit more resilience as well, comparatively just down 0.4%. You're seeing that selling pressure coming through for electric. Schneider down 2.2%. ASML, of course, with the lithography machines and that exposure to chips, currently falling at 3%. So that's the worst performer across the Core 6. The luxury space was badly hit yesterday, and that sell-off continues again today. LVMH down 2.3%. The defence space, Rheinmetall, after gaining yesterday, currently down just 0.1%.
Coming up on the programme, Spain's Foreign Minister, José Manuel Albares, tells us how Europe will respond to President Trump's latest Iranian strikes. Our interview is next. This is Bloomberg. Welcome back. This is the opening trade. 15 minutes past 8 here in London. And in London, we have a bit more resilience coming through on the London market, but not by a huge amount. Naturally, the gains we'd seen in energy stocks, Tom, just fading. We are now seeing negativity even around energy stocks. So all sectors in Europe are in negative territory this morning. OK, and that ties, of course, directly to what's happening in the Middle East, where German Chancellor Friedrich Merz has voiced his concerns about the unpredictable fallout from the US and Israeli strikes on Iran, remarks that risk straining ties with the White House when he arrives to meet President Trump today. Merz will have to present European interests at a time when both the UK and Spain have denied the US permission to use their bases to attack Iran, though it's worth noting that the UK has allowed the US to use its bases in a defensive manner and defensive capability. Spain's Prime Minister Pedro Sanchez said the US and Israel's actions have added to a, quote, more hostile international order. Joining us now is Spain's Foreign Minister, José Manuel Albares. Sir, Minister, thank you for joining us. Why take a stance against the US and Israel in terms of the military action they're taking on Iran? And do you plan to go further than rhetorical condemnation at this stage?
We don't go against anyone. We go in favor of international law, de-escalation, negotiation, and regional peace and stability in the Middle East. That's where we stand. And we want to be a voice of reasons and balance. And we are coherent with our foreign policy. We say the same things with the same objectives and under the same principles, whether it's in Ukraine or in Venezuela or in Gaza or in Iran. We have been very clear concerning the regime in Iran. We have condemned every single human rights violation and the brutality of the Iranian regime against its people. We have condemned the unjustified attacks of Iran to basically every country in the Middle East. But we want military actions always under the United Nations Charter and under collective effort. When we don't see that, Spain raised up its voice to signal that that's not the right way to go.
Yes, Minister, and you mentioned those Iranian attacks on other regions, other countries within the Middle East. Why not then allow the US to use Spanish bases in a defensive manner to protect those nations against that Iranian hostility?
The treaty between Spain and the United States established a scope of the bases and for the use of those bases that are Spanish bases under Spanish sovereignty, but of joint use. And at the same time, we want all actions that are carried through those bases to be and falling under the United Nations Charter. So anything that is inside the treaty and in compliance with the United Nations Charter, it's okay for us. Everything that goes out of the scope of the treaty and that has not the backing of United Nations Charter, we will not allow the use of our basis for that.
Minister, do you assess that you are taking a different position from France, Germany, and the United Kingdom. I mean, on the subject of France and Germany, does that matter that European EU voices are on a different page?
We think that every country has the right to make its own analysis and its own foreign policy. Basically, Spanish foreign policy is being coherent, is being consistent in wanting peace, de-escalation, criticizing and condemning all the violation of human rights everywhere, of course, including in Iran. We have voted every sanction to the Iranian regime, including the Revolutionary Guard from European Union. But we think that Spain and the European Union and Europe must be a voice that establishes a balance, that talks about de-escalation, that talks about protecting and defending international law, that a world that is based on predictable rules, it's better than a world in which the force is the only rule. That's where Spain stands, and there is where we think Europe must stand, and I made it very clear the other day in the Foreign Affairs Council in Brussels.
Do you think that, is there any chance that this turns into a NATO operation, Minister? I mean, under Article 5, we are seeing NATO troops being attacked, not in NATO countries, understandably, but there are attacks against NATO troops. What would turn this into a NATO operation?
No, I don't think so. No one is asking for it, and I haven't heard anything or anyone talking in that sense. The situation is already very complicated, very, very complicated. We see this instability everywhere in the region that is affecting also many of our citizens. Spain has more than 30,000 Spaniards in the region, and today we have good hope that the first one will start to get out through commercial flights, but we are struggling to get them back to Spain. We see attacks everywhere. The situation is already complicated enough as to introduce political fiction and to complicate it even more.
Minister, have you had conversations with your partner, with your counterpart in the US Secretary of State, of course, Marco Rubio, since the conflict started? And if so, has the US been putting pressure on Spain?
No, I haven't had. I've talked with him several other times. I was very kindly invited to the State Department, and we had a very good conversation there. But all that was prior to this military intervention. No, we are not getting pressure. We are allies. We are together in NATO. There is this bases here that are under Spanish sovereignty, but are of joint use. No, there is no pressure at all.
There will be those in the US who would question whether or not you are behaving like an ally. You're not allowing those bases to be used. You are not meeting that 5% target for NATO spending, and you are condemning the US. You talk about instability, Minister, but you are not putting the money where it needs to be in terms of the defence space in Europe and in NATO. That would be the accusation from some.
We are one of the most committed allies in NATO, and we are one that is contributing the most to Euro-Atlantic security. We have a historical deployment of soldiers, aeroplanes in the eastern flank of Europe, almost 3,000 soldiers. Our aeroplanes are guaranteeing the security of the Baltic states and therefore the Euro-Atlantic security. For 70 years, we have two bases here that have been of joint use with the United States. We have our soldiers in UNIFIL under UN flag. We have them under NATO flag in Iraq. We have been together for almost 20 years in Afghanistan. So I really would like to see if there are countries within NATO that are doing so much meeting the targets that are put. All the capacities that NATO asks to Spain, we are providing them.
So when will Spain spend 5% of GDP on defence?
What we are doing, and that's how we approach things, is that we are meeting all the requests of our capacities that are requested from NATO. And we think that with 2.1% of our GDP is enough. The way we do it, and we think is the right way of doing it, is we see the threats that we have. Once we see the threats, we see the capacities that NATO is required from Spain to meet those threats, and then we quantify them. And what you can be sure is that we are and we will continue delivering all the capacities that NATO requests from us. And that means 2.1% of our GDP. Putting 5% out of the blue without knowing what capacities are required is taking resources that might be needed somewhere else.
Minister, do you have a base case assumption about how long the war in the Middle East lasts? What are you, as a government, assuming?
I really cannot answer to that question. It's more to those that are involved in this war, the United States, Israel, that they are the only ones that can know how long or what they foresee. What is very clear already after a few days of war is that we are under unpredictable consequences, certainly for the region, but probably well beyond.
Yeah. Minister, gas inventories in Europe are seasonal lows. We're seeing gas prices spiking again in the session today. Does Europe face an energy shock?
Not so far. We have very reliable suppliers, including the United States, in LNG, for instance. But what we see is that the prices are rising. And, of course, it's a situation of concern for every country in the world.
Minister, Spanish Foreign Minister José Manuel Albares, thank you very much indeed, sir, for your time this morning. We appreciate it. Let's check in on European stocks right now, and we'll start on the benchmark. Stocks 600 is currently down 1.9%. Heavier selling that we saw yesterday, building on those losses. You're seeing every single sector in negative territory, including energy, which is down 0.6%. The DAX over in Germany tumbling 2.2%, as you can see. Over in France, the CAC 40 off by 143 points, and the FTSE 100 dropping 159 points, and gilts selling off and pretty aggressively.
Yeah, I mean, part of the energy story is about the price. The rest is about the volume. And maybe that's what markets are responding to today with those energy stocks weaker. Energy prices are much higher. When you look at UK natural gas prices up by 25%. TTF, that's the European benchmark, up by 24%. We're not at levels we saw in terms of euros per megawatt hour during the start of the Ukraine war. We're at 54 euros, not 340, but still the movement is dramatic and it is upwards. If we look at oil prices, the Brent price is up by 3.4%, WTI up by 3.2%. Interesting, we could see those diverge as this conflict continues then, Tom.
I just want to note and check in again on gilts, because the sell-off is pretty significant, particularly at the front end. So yields up 11 basis point on the 2-year. Traders no longer pricing a second Bank of England interest rate cut this year. That is a pretty marked shift, and that ties to your point around high gas prices. There's the sell-off in gilts. US futures as well, after showing a bit of resilience in US markets yesterday. S&P E-minis pointing low by 1.3%. Nasdaq 100 futures pointing low by 1.6%. We're going to talk to Tobias Ellwood, the former UK Middle East minister, as Britain grants the US permission to use its bases. That analysis and insight is coming up. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes into today's session. Let's have a look at where we are across European equity markets. And the answer to that question is in the red, down by 2% on some of these markets. So the Xetra DAX in particular, down by 2.3%. Elsewhere, the CAC 40 down 1.8%. And the FTSE 100 cushioned a little, but not really much. And that's, I think, Tom, is what sets today apart from yesterday. Yesterday, energy was much more of a cushion against the negativity. Today, we see even the energy sector in negative territory.
Yeah, less support from the energy sector, less support from the defence space. And we saw that come through yesterday. But to your point, that has adjusted in terms of that dynamic today. In terms of volumes, spiking in the session today, up almost 40% versus your 20-day average. Let's break it down in terms of your members higher versus members lower. Given the significant and broad spread sell-off that we're seeing, not a big surprise to see that just 41 stocks are in positive territory so far and more than 556 in negative territory right now. Let's break it down and have a look at some of the leaders then. There are a few of them, and that is in the oil space. A couple of names then seeing higher pricing and higher stocks on the back of what we're seeing in terms of the oil price spike. BP, a beneficiary of barrels of oil, and Brent above $80 a barrel. BP up 1% in the session today. Equinor getting an even bigger boost, up more than 3% so far. Lottomatica also gaining close to 5%. So amongst the gainers is the energy space that again dominates. Let's flip the board and have a look in terms of the laggards. And it's a reminder, it's not just that energy shock that we're having to deal with, it's also the supply chain shock. And ASML is a feature there, of course, the maker of these extreme lithography machines that go into the chip sector. And there's a constraint given what is happening in terms of the Straits of Hormuz and the effective closure of that shipping route. So ASML under pressure as a result of investor concerns about how they ship their products to market. The semiconductor space also feeling the squeeze more broadly, down 3.6%. Natura Energy, they have to buy in a lot of the energy, so of course there's a constraint there. Currently falling more than 7%, and Bayersdorf falling almost 13%. That's on weak guidance. It's less about the geopolitics. That may be also a factor, but it's a guidance story coming through weaker than expected. And again, it's the supply chain challenge more broadly. There's a constraint for the likes of the chip space. Anna, what else are you looking at?
Yeah, let's go through some of the other stories that are in focus for us this morning. BlackStone Private Credit Fund has been hit by record redemptions. The firm is allowing investors to redeem a record 7.9% of shares from its flagship private credit fund. The surge in withdrawals adds to growing unease over the asset class and its exposure to software businesses at risk of disruption from AI. Russia and Ukraine are said to still expect planned US-led peace talks to go ahead this week, despite the United States military campaign against Iran. But a source in Moscow says the meeting is unlikely to happen in Abu Dhabi, with Turkey or Switzerland among possible alternatives. This would be the fourth meeting between the sides this year as the US seeks to broker a deal to end Russia's war in Ukraine. And senior gas executives say that China is pressing Iran to avoid disrupting energy shipments through the Straits of Hormuz. Beijing is urging Tehran not to target oil or LNG tankers or key export hubs like Qatar, which is a major LNG supplier to China. Tanker traffic through the critical waterway has effectively halted amid escalating conflict in the region, raising fresh concerns about global energy supplies.
The US is sending conflicting messages about the duration of that war with Iran. Defense Secretary Pete Hegseth rejecting the idea of, quote, an endless war, but President Trump has vowed to do whatever, quote, whatever it takes. This, as Bloomberg learns, the UAE and Qatar are privately lobbying allies to help persuade Trump to reach for an off-ramp. But US Secretary of State Marco Rubio insists the military campaign could be stepped up.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
Let's bring in Bloomberg's Jumana Pasechi standing by for us in Dubai. Jumana, are we any clearer on the U.S.'s strategic objectives with this military campaign?
Well, I think the two questions people are asking is what exactly are the U.S. trying to achieve? And the second is how long is this going to go on for? Yesterday, President Trump said that they would do whatever it takes, quote, to achieve those objectives. And he said from the outset, we projected 4 to 5 weeks, but we have the capability to go longer than that. Later on, the Secretary of Defense, Pete Hegseth, said that this is not an Iraq situation. They're not planning on this turning into an endless war, but a protracted campaign is within the realms of expectations here. And what we know is that the U.S. continues to beef up its assets in the region. We just heard of the Secretary of State, Marco Rubio, suggesting that the strikes are actually going to intensify in coming days. Over the first 2 days of the conflict, the U.S. targeted more than 1,100 sites within Iran, military infrastructure, rocket launcher sites, nuclear sites as well, with some of those stealth bombers targeting embedded nuclear locations. And obviously those are the more tricky ones to get access to. And they continue along as well the path of targeting senior personnel and the headquarters of the Revolutionary Guard. This morning they took out a central command unit as well. So alongside that, President Trump and the Israeli Prime Minister have been calling on the Iranian people to rise up. There hasn't been any sign of that happening. But again, over the coming days, perhaps the U.S. calculus is that the Iranian regime will sustain so many blows that they will have no choice but to capitulate. At the same time, it is also noteworthy that overnight the U.S. has sent a message to all American citizens within the Middle East, and this is pretty much all of the countries in the Middle East, urging them to leave the region. And of course, it's very difficult for them to do that given most commercial flights have been canceled.
Yeah, I was struck by the sheer list of countries, the length of that list of countries, Jemana. It's interesting thinking about the impact that this is having where you are and other countries within the region. I noticed there's some reporting in the Middle East suggesting a fire at Fujairah's petroleum industrial area in the UAE, that coming from other TV within the region where you are. And this takes us back to the impact that this is having on the energy infrastructure, but also the lives of those in the region. And we know from our reporting that the UAE and Qatar are putting pressure on their allies to try and persuade President Trump to find an off-ramp to this conflict. And you wonder if any off-ramp is in sight.
Yeah. Precisely that, Anna. And you could say that in the last 2 days, there's been a marked escalation in terms of what Iran has been targeting within the Gulf states. Energy infrastructure, logistics, key ports. We've talked about, obviously, the disruption along the Strait of Hormuz, but a big escalation on the energy side of things yesterday, targeting those LNG facilities, a key Qatar LNG facility alongside the refining capability in Aramco as well. And this morning we're hearing of that fire that's ongoing in Fujairah. So as far as Gulf states are concerned, this is a significant escalation from where they thought the Iranian response could lie, which was initially directed at some of the U.S. assets in the region. But now it's become very much directed at some of the key energy infrastructure that directly and economically impacts what these Gulf states are trying to achieve in terms of overall stability. And so our reporting suggests that Qatar, UAE are trying to look at some form of a diplomatic off-ramp to thwart the possibility of this turning into protracted conflict and sustained higher energy prices. They've been reaching out to leaders, their counterparts from around the world, including some European leaders as well. But at the same time, I would also point you to a statement that was put out by the GCC foreign ministers over the weekend, emphasizing that the member countries will take all necessary measures to defend their security and stability, including the option to respond to the aggression. And so you can read that as you will, but the point is that they are exploring all options here. And there is a perception in the region that Iran have gone one step too far.
OK, Jemana Besechi, thank you very much indeed with that update, of course, out of Dubai, out of the UAE. For more analysis, let's bring in Tobias Ellwood, former UK, Middle East and North Africa Minister, also former UK Parliamentary Defence Select Committee Chair. Tobias, thank you very much indeed for coming into the studio. How do you characterise this moment right now?
Well, so much to unpick here, but let's start with Iran. The fact that you've got Donald Trump, the American president, saying to Americans, get out, that suggests that Iran has much more to firepower in the bag. And that's what we're going to see. So Trump is going to say, yes, there's more to come. You heard Rubio saying that we're going to fight further. It'll last another 4 weeks. But to tell Americans to get out, that means Iran remains a viable threat. It's not going so much for Israel or indeed for those ships in the Mediterranean and in the Indian Ocean because they're protected. It's going for the lower lying fruit, which is the rest of the Gulf. It's American assets, embassies, and other targets right across the Gulf itself. It begs that question, what does victory look like? And this is the worry. You've touched on it this morning as well. And I worry about mission creep because any soldier, any general wants to know, what am I doing? What's the political outcome? And you ask different people in America, in the leadership, in the White House, you get different answers. I see 3 outcomes potentially. Yep. Firstly is that you have a regime change and then America dials back, but that ends up in civil war. The second one, which I think is what Trump is probably pointing to, is the Venezuela approach. That the regime stays, but under new leadership, it's subservient to America. It promises to stop doing its nuclear ambitions, long-range missiles, and its proxy support across the Middle East, and it'll behave itself. But that isn't what the Iranian people want, nor is it the message Trump sent earlier to say, this is your moment to rise up. The third option is the more advanced, and what I think the people would like, indeed the world would like, is never in decades have you had an opportunity for Iran to step into a new chapter. So the regime collapses, then the international community steps in, helping support an interim government, rewrite the constitution, and move Iran into a better place. But all that last option is far too much work, too much detail for Donald Trump to get his head around.
But so, to be clear, you're not seeing a clear strategy from the US. Do we therefore end up in a situation where this becomes a war of attrition over weeks rather than over days.
It's worse than that, because it's the word mission creep, I'm afraid, is now coming in to the lexicon when we're describing what's going on in the Middle East. There's absence of clarity, and don't forget that America, indeed much of the West, are very casualty averse. As soon as those numbers start to clock up, and we will see them, I'm afraid, both civilian and military, then the domestic pressure in the United States will rise to ask, what on earth are we doing? And don't forget the American president promised not to get engaged here. It goes back to the start of this, I'm afraid, that it was Israel, Netanyahu, it seems like, Rubio confirmed this, they were going to attack Tehran anyway. So America said, well, we better move in too, because Iran's response will be hitting Americans too. We better strike first, preemptive, weaken them. But you now opened up this Pandora's box. Where do we go next?
And then you're into the question of how other nations respond, and let's think about the UK response, Tobias. Let's just play a little clip of the Prime Minister yesterday speaking to the Commons.
To be clear, the use of British bases is limited to the agreed defensive purposes. We are not joining the US and Israeli offensive strikes.
The Prime Minister there, and of course you were in Parliament representing the Conservative Party, not his Labour Party. But I wonder what you make of the stance that the Prime Minister, the UK government, has adopted here, Tobias, because for some people this is far too nuanced. You're either with America or you're not. For other people, this is exactly the right path to be taking. It's saying you can use our bases for things that are legal and you can't use our bases for things that are not.
Yeah, I think this idea that we're either with America or not is too simplistic. It doesn't actually give justice to the scale of the problem that we face. It was right, I believe, that we questioned Donald Trump's intentions to attack Iran. Personally, there's the international laws as well. You're only supposed to attack another country if they're attacking you or about to attack you. That threat wasn't imminent itself. But a line is crossed as soon as Donald Trump and indeed Israelis went in, because Cyprus was attacked. British assets across the Gulf were attacked. Our allies were attacked there. So that opens up a new period of engagement. Yes, reflection must come. We must look back in the longer term, but that's not for now. Now is operationally. We should be putting more assets into Cyprus, protecting that, certainly supporting our Gulf allies as well, and then asking ourselves the difficult questions, as I touched on before, trying to persuade Donald Trump, where are you going with this? And my worry is that we're going to end up with a Venezuela outcome.
Right. Well, I mean, he wants a Venezuela outcome, doesn't he? He cited Venezuela as a positive.
But then why tell the Iranian population, the citizens there, rise up again, come back out on the streets again? Remember what happened last time, only a couple of months ago, when he encouraged that to happen and the slaughter we saw from this regime. This is the other case, as I touched on, is civil war, because there's no clear leadership. The idea that you're going to bring in the Tsar's son, who's based in Washington, to somehow take over, that isn't going to happen either. It's a diverse country. And
it's divided, yes, exactly, on whether any replacement would be more
democratic. And the biggest force, the biggest institution with the most capability is the Iranian military. So you then replace a theocratic dictatorship with a military one. We end up with a Saddam Hussein in Iraq, but in Iran.
You said that this is not a time for maybe deep reflection, it is a time for action. But, I mean, what was clear in the UK context is the shadow of the Iraq war hangs over everything that was said in the House of Commons yesterday. I mean, you must have reflected on the UK's involvement there and the things that the UK says, yes, it will do for American allies, and the things it says it won't. How do you think that this is playing out under the shadow of Iraq?
Well, it's not just that, it's what happened in Syria as well. I remember the vote in 2013 when Assad was using chemical weapons on his own people, but the parliament voted against the government to provide support for the Syrian people, and so Assad survived for almost over another decade. And Iraq, absolutely right. Prior to that war, prior to the conflict, I said no, this isn't justification to march in, partly because I didn't see a plan, I didn't see a strategy, and this idea that you can use military might. Didn't the Americans learn in Vietnam that isn't the way to do it? That you cannot bomb the regime into submission from up on high. There needs to be a political outcome that everybody is then satisfied. And that means working with the locals as to what the solution is.
Tobias, before we let you go, you mentioned the UK should be looking to put more assets into places like Cyprus. Doesn't this situation in Cyprus remind us of just how weak our military is? What is the gap? How concerned should we be about UK military ability to defend ourselves?
Oh, my goodness. I mean, this is just another big question that I'm afraid Britain has failed to address. We're a peacetime mode in our military. Our Army, Air Force and Navy are just far too small. They're overstretched. And then there's the other domains of war, cyber and space, where we're completely vulnerable. And governments, I'm afraid, have been too slow in recognizing that our world is becoming more dangerous, not less, and not investing. There's something called the Defense Investment Plan. We had the Defense Review last year, pointed out to how open we are to attack, what we need to do, clear recommendations, and the government has sat on its response in this government investment plan. Helicopters, medium-sized helicopter, I'm sure you've discussed, is one example. In 1990, we had 50 frigates and destroyers. Today, we couldn't muster more than 6. We had 5 divisions in the Army. Today, we couldn't muster more than 1. We had 36 fast jet squadrons. Today, we only have 6. We are so vulnerable. We are not prepared for what's coming over the hill.
Tobias Ellwood, on that note, former UK, Middle East and North Africa Minister, thank you very much indeed for those views and for those insights.
Coming up on the programme, the Chancellor Rachel Reeves is set to deliver the UK spring economic forecast later today, just as we see UK 10-year bond yields climbing 10 basis points as the sell-off in government debt. That's not a UK story, that's global, but that's continuing. We'll get a preview of the spring statement. That's coming up next. This is Bloomberg.
Welcome back to the opening trade. We are 50 minutes into the Tuesday session. The European session is reminding us that the relative outperformance of European stocks year-to-date versus their counterparts is being challenged by the conflict in the Middle East. So stocks down now across the benchmark 2.4%, some pretty heavy selling. Over 2 days, you're looking at stocks off by about 4% in terms of what we're seeing in Europe. You had seen some relative resilience when it comes to the US markets yesterday, particularly when it comes to the tech names. And today, that is being challenged. S&P E-minis currently pointed lower by 1.5%, and Nasdaq 100, with, of course, that exposure to tech, currently called lower by a little over 2%. It's not just the energy shock, of course, the equity markets are having to contend with, but also the supply chain squeeze as well as a result of the conflict in Iran.
Yeah, and repricing of inflation expectations and what that does to global interest rates certainly happening apace. We saw that overnight coming through from Australia, but here in Europe, we're also seeing plenty of it as well. We checked in on what was going on across the European bond space earlier, and they're all in the mix. But I'll focus here on the UK because we're going to be hearing from the UK Chancellor a little bit later on today. We're up by 10 basis points at the 10-year horizon and up by a little more than that, 12 basis points at the 2-year horizon. Now, the comfort might be that this is a global story. That's not to do with the UK, but maybe that comfort doesn't last too long. Rachel Reeves will deliver an update on the state of the UK economy later today, focusing on the government's economic plan for Britain with a deliberately stripped-back speech. The Chancellor is seeking to break Britain's recent pattern of fiscal statements that destabilise the market. So, we're told, she wants to have as little impact as possible, perhaps. Lizzie Burden joins us now from Westminster, regardless of the low impact intended by the Chancellor. Lizzie, what are we going to be hearing then from Rachel Reeves later on?
Well, this spring statement has been dubbed internally at the Treasury as the spring forecast. The Chancellor wants it to have so little market impact. But of course, it's overshadowed by the US-Iran war. And this is the first time that we'll be hearing the Chancellor's response to the economic implications of that war. We're expecting her to emphasise the need for fiscal stability, as we were anyway. As you say, it was expected to be a policy-light event. Now, of course, the market's on high alert for any lurch to the left from this Labour government, given that defeat in the Manchester by-election last week. But we're not expecting any big tax or spend measures, not on the defence spending hole that you were just discussing with Tobias Ellwood, not on how they're going to fix unemployment. All of the big tax and spend measures are expected to be punted to the autumn. We will get the updated growth forecasts from the Office for Budget Responsibility, expected to be sluggish for 2026 with higher unemployment, and we'll be able to calculate how much fiscal headroom the Chancellor has against her fiscal rules, that, well, one of them is day-to-day spending should be covered by tax receipts by the end of the Parliament. Now, we know that headroom was £9.9 billion, raised to £20 billion. The expectation among economists is that it stays at £20 billion, although Goldman analysts say it could go up to £25 billion. And we know from our colleague Tom Rees's reporting that she's had a windfall of £22 billion from stronger than expected cash tax receipts and lower than expected debt interest payments. So that should allow the Debt Management Office to slash gilt, the gilt remit, gilt sales, and that should give a boon to the gilt market with gilt yields falling lower.
Lizzie, thank you very much. Bloomberg UK correspondent Lizzie Burden with what we're expecting from the Chancellor later on today. And we'll bring you coverage of the Chancellor's spring statement from around midday UK time.
OK, let's turn back to the markets and bring in Bloomberg MLI's Skylar Montgomery-Koning right now. It's one of those days where you don't really know where to turn in terms of some of the asset price moves. We've seen the dollar up about 50% on the Bloomberg, 0.5%. 50% would have been a move, wouldn't it? 0.5% move on the Bloomberg dollar index is nonetheless significant. We're seeing that sell-off, of course, in the sovereign debt. You're seeing that sell-off in gilts with yields up, and you're seeing pronounced sell-off in terms of what's happening across equities. What stands out to you? Where are we in this story, Skylar? How much is this tied to the gas price moves and the oil price moves?
I mean, that's the number one driver, right? If you look across markets, whether that be FX markets or equity markets, there's this clear divergence between those that will benefit more so from higher energy prices and those that will be punished by higher energy prices. And I think the point is, yes, we aren't at extreme levels in Brent, for example. We're at $80 a barrel versus on Russia-Ukraine, we were well above 100. But what matters for your economic situation is what the delta is. So what's the change? And if you look at Europe and the UK in particular, European natural gas prices up something like 30% from its one-year average. UK natural gas prices up 60%, and that has to have an economic consequence that'll feed into markets.
And this volatility is set to continue because we don't have a handle on how long this lasts, I suppose.
Yeah, I mean, that's exactly it, right? Your economic consequences depend on how much your energy prices rise and how long they stay elevated. And so the worry is really that it's a stagflationary shock, which is the worst environment for asset markets because equities and bonds both come under pressure. I think, too, the assessment from an equity perspective is what is the benefit to your energy producers from the fact that they have higher prices versus, you know, the tax on consumption from stagflation, the fact that you have higher input costs, et cetera. And so we haven't fully priced the extent of those economic consequences, so there's more to feed through still.
OK, Bloomberg's Skylar Montgomery-Koning, thank you very much indeed. With another pulse check there on the markets and some pretty pronounced moves across equities, across the bond space and in FX as well. The pound under pressure by about 0.8%, falling today.
Yeah, the dollar on the rise again. And I'm drawn to the extent of the losses we're seeing for European stocks today. So it's like yesterday, if not worse in some places. So the Stock 600 down by 2.7%. You've got the Italian and the Spanish markets both down by 3.7%. So these losses are quite deep across European equity markets, and US futures also pointing lower. So we'll leave you with that as we head towards the pulse. That is it for the opening trade. Have a good day, everybody. We'll see you on the other side of the pulse. This is Bloomberg.